Good afternoon, everybody. Welcome back to the Opportunistic Trader. We're now joined by Brynne Kelly of the Fundamental Angle. Brynne's been providing some great information on the energy markets, natural gas, electricity over the past few weeks, and it's great to have Brynne joining us. Brynne, you there?
Yeah, welcome. It's a tough act to follow, Mark's enthusiasm.
Yeah, before the holiday weekend, Mark was very excited about, very passionate about a few different markets.
Yeah, just kind of feeding off of Mark's excitement about, October and natural gas. And, he's not sure exactly what's going on, but feels like something is going on. There are kind of a couple things, along those lines that are kind of waiting in the background. One is starting with the September 7th natural gas storage report that will come out on the 13th. They're changing their methodology for the way how they sample. So they've changed the way the storage report works is that there is a sample group that reports, and they've changed that sample group. So they take some people out and they put some people in. Overall, you wouldn't expect that it would have a bunch of impact, but it's getting a little bit of hype and you never know. And I think once we get that report behind us, the reality of where storage levels are will be able to kind of set in. As it stands right now, we're just waiting for, what if there's some big surprise in this and storage numbers, the levels are, somehow much higher. I would say that's maybe the fear that people have. So he's right in that there's kind of getting some anticipation around that and just getting this. So we have we have next week's report, and then the following week is when we'll really be able to see that and find out, if it's any big issue and move on.
Well, tell me this, based on volatility, I just brought up a chart for everybody can see. It looks like for going back, this chart that I brought up is about 5 or 6 months. It looks like we've been down to about 265 and as high as about 305. Right now trading about 292. Regarding like historical volatility, is this considered one of the lower levels that we've seen on a yearly basis?
I guess the only thing I would say about that is, starting from a couple years ago when we were down below $2, volatility is kind of a function of how low the price is as well. 50-cent move on $1.50 versus on $3.50. So I would say the last 3 summers have been low vol. But this is as far as lack of interest in the winter months, given that this is the first year in several that we're not, running so full in storage that we're worried we don't know where we're going to put it in October. So it's unusual in that it's not really driving any interest in the winter months yet.
Well, I know that you showed a chart a few weeks ago that you basically typically show that August is the quiet month, basically bracing for the final 4 months of the year typically.
Yeah, well, and the way that, natural gas trades, it's 2 strips, the winter strip and the summer strip. And October is the last month of the summer strip. And so typically once, that's it, either the prompt contract or it rolls off, that's when people kind of start really looking at Novi March and that winter strip and that things take off. So, and October ends up being a function of either weather from like hurricane hype or ratchets we've had the last few years, in that we've been so full by October in storage that you kind of get some messy cash because, storage is ratcheting down how much they can take in as they get fuller and fuller. But, this year you'd expect it to be a little bit different. And so October could be a much more exciting month finally, but really October cash. So from that standpoint, you already have the futures off of the board. But
Right.
they've kicked the can down the road far enough, and we have 10 weeks left of the official storage season, and we're at like 2.5. Easily we've should get to and have gotten to 3.5 and above. So even if we put 100 in every week until the start of storage season, it's not like we'd be at record levels. And so far we haven't seen anything close to that on the weekly injections. So as far as and I think I mentioned this in my last time I was on, if you wanted to think about a year where the conditions finally exist to get excited, this could be the year. It's been several years of just increased production, and trying to cope with that. Same thing that we had in crude oil. We had a couple years where production was ramping up so much, and we were, all of the infrastructure was basically trying to accommodate that. And as a result, prices came off and it got really messy. And, we're still lagging a little bit behind and catching up, with natural gas on, balancing out the supply and the demand and kind of getting settled into a new normal.
Well, one thing I wanted to comment on, because we were talking about it before, I don't know this for sure, but I'm pretty sure that Mark wants to be bullish natural gas basically, but is waiting for the price confirmation. So he's not, he thinks it's going to go higher, but isn't necessarily positioned that way at this moment. And I'm actually not I think that's how he is. And so he's waiting for that catalyst to be able to jump in. And, and you mentioned before, he thinks that you're bearish, but you're in a way
the same.
Opportunistic, right? You're waiting for
that's
that
right.
sort of move.
You're right. Right. Well, good clarification. I mean, for sure, I think the conditions could exist, but so far there hasn't really, it's not as if it's running away from you or you need to be some sort of hero and just sit around with a long position, riding it and twiddling your thumbs. So I agree with him. When you start to see some movement, that's, I think, when some angst will set in. And the angst will be, prices have just been so low for several years, and there's been plenty around, and there still is. I mean, production is at records again. But, timing now, I mean, we don't have 30 weeks of the storage season left. We have 10. And so creating a little angst without a price pullback is what would be an indicator for me.
Yeah, absolutely. It's definitely something to keep an eye on, and I hope both you, Mark, and everybody else, as soon as you see those sort of signals and we see, a clear sort of trend in trade, that we kind of look for that and, hopefully can capitalize on that.
Yeah, and I mean, so we all kind of know, that story. We're not having a lot of movement in natural gas. Everybody's got an eye on it. So rather than, talk about just that every day, I've been trying to just dig a little bit deeper and spend some time on some different aspects of the gas market, because I think it's always good to have the bit of knowledge in your toolkit once things really start moving. Then you have just a little bit better way to interpret moves as they're made. So today I thought I would talk about gas basis. Everybody in all the other markets think basis or use the term basis to mean the difference between cash and futures. And in natural gas, basis is actually a futures contract, essentially. There are basis futures, and it's the difference between Henry Hub and any other delivery point around the country. So, but during the same time period, it's not cash to futures.
So that's interesting. So there's an actual futures contract on the basis of all the different, or of many different ports?
Yeah. So if you go to the next slide.
Yep.
So I thought it'd be interesting just to give people a sense of the size. So there are three main futures contracts that trade in natural gas. Obviously, just your fixed price Henry Hub, and then you have your basis futures, and you also have index futures. And basis is the difference between one point and another point in the country, and index futures are the difference between a monthly price and daily prices. So, for example, if you wanted to trade the difference between the first of month price for September and the gas daily, the average of the daily prices for the month, you would buy an index future. So it's gas monthly versus gas daily. And they're generally all Platts inside FERC. So that's what they settle against. So they're financial futures. And in this case, I just took a look at, just to show everybody, because I know people like to look at commitment of traders reports,
Right.
and look at longs and shorts. And sometimes I feel like maybe they're not really drilling down underneath the hood. And maybe for the point of using commitment of traders reports, it doesn't matter. I don't know. But what I'm showing here is the CME futures open interest for natural gas versus ICE. And both of them have a Henry Hub futures contract. The difference is that NYMEX futures trade one lot equals 10,000 MMBTUs. So one is 10,000 and that's it. For the last day futures for Henry Hub on ICE, one lot is 2,500 MMBTUs per day. So it essentially then equals like 80,000 for the month, right? It's 2,500 times or 70 times 30 days in the month. So that would be 7 NYMEX contracts.
Okay.
So when you look at the open interest column for ICE, for Henry Hub, you kind of have to do the conversion, right, to get to a CME equivalent. And you can kind of see that, I guess I don't have my mouse here to point, but you got the CME equivalent for Henry Hub. It's the first line, and then you go down to almost the bottom, and you have Henry Hub for NYMEX. Pretty similar, right? But now you have the open interest for all of these basis futures. And these are the ones generally with the most open interest. So they're only listed in size order here, but you can see ACO, that's the Canadian border. Dominion South is up in the Marcellus region. You have your Houston Ship Channel, Chicago basis, and it's all combined. ICE basis futures is larger than Henry Hub. So just something for people to note. It is kind of the staple of the natural gas business, because it's one thing, to hedge with Henry Hub, but it's a whole different thing. Production and consumption is so regional, and there are huge price differences between Henry Hub and different parts of the country. So if you go to the next slide.
What's the title?
How basis is used as a hedging tool.
Okay, perfect.
That one. Yeah, sorry. I guess I
just wanted to make sure, right?
Yeah, so I, and this could be rudimentary, fundamental for some people, but I think it's just kind of good to have it in the back of your mind. Even if you're looking at equities and some of these producers, it helps you kind of understand when there are big basis moves in the winter markets, how it might impact a consumer or like a big industrial, for example, or a producer, whether they're hedged or unhedged. So I'm just using, I have M3, that's TECO M3, that's kind of in the Marcellus Shale region. That's a basis location. And I'm just taking a look at a basis transaction if you're a consumer versus a producer. So basically, to buy basis means you're buying the regional location, in this case, TECO M3, and you're selling NYMEX.
Right.
So the buy and sell is referred to as, it's stuck with the location, right? So if you're selling basis, you're selling the basis location and buying NYMEX. So if you were to think about a producer, if they were to have a perfect hedge, for example, because I know, people like to talk about, well, the producers, that they've hedged this much with NYMEX. In reality, the way a producer hedges is that they would sell basis, and it's kind of, if you look on the producer line, which is the equivalent of selling the location, which would be TECO M3 in this example, and buying NYMEX Henry Hub. And then to lock in that actual M3 price, you would turn around and buy back the NYMEX contract. So in theory, producers would be selling basis and buying NYMEX. And that would make them then have a sale on their books at the location where they're producing. A producer that just sells NYMEX only to hedge against their production is long basis. In that way, if basis crushes during any period of time, their NYMEX hedge did not protect them from some, and some of these basis moves can be several dollar
Right.
swings. So I always think that's something to keep in mind, right? I mean, if you want to talk about producers and you were to talk about how they would actually, in a perfect world, hedge natural gas, they would actually be buying NYMEX against selling basis if they wanted to lock in their price. They've actually exposed, by just selling NYMEX, they're exposing themselves to a lot more risk, because it'd just be like going out and going long basis in the market. And I'll show some of those futures curves in a couple slides. And then of course it's the same thing on the other side with consumers. If they're regionally a big user in the Northeast, in this example using TECO M3, they would buy the basis and then they would turn around and sell NYMEX, so that they would have just locked in the regional price that they needed.
So take me through, why is that different from, let's say, call it corn?
Well, to be honest with you, is there a liquid futures market in corn for locational spreads?
I don't believe so.
I don't trade corn.
No, I think that I think it trades in the cash market liquidly everywhere, but not in the futures market.
Now, the other thing and again, this is just me, you kind of caught me off guard. I'm not a corn market trader, but I would say the corn is much more easily transported than natural gas.
Okay, so maybe one of the reasons you're saying is because of transport.
Yeah, I mean, there are fixed amounts of pipeline space. The inventory is kind of just in time.
Mm-hmm.
When you're looking to get it in the spot markets, either sell it or buy it, right? You're not really picking a bunch of corn and putting it,
right. Well, you can actually store. Correct. You can store it for a long time.
Yeah. So unless, and especially, in winter months where, storage is normally only a withdraw, whatever you're producing, you're selling immediately. And so in that way, just like in the electricity markets, there are huge dislocations in the spot market.
Right.
That, exist because of the nature of the deliverability and the infrastructure.
Okay, that makes sense.
So there's X amount of pipeline space, into the Northeast versus into the Houston ship channel. It's just to get the molecules where you need them in the moment may not be possible.
And what's the liquidity on these contracts? Is it as how would you relate it to, like, let's call it NYMEX, that's trading front month NYMEX, the basis contracts?
So if you go back to the slide that has open interest on it,
Yeah.
you can kind of see based on
Right. So open
total
interest,
open
Henry Hub,
interest,
we're
it
looking at like
varies.
over 5 million, and CME equity 1.3, whereas some of these basis might have a few 100,000, so less than 10% potentially.
Right. And that's for futures. Now keep in mind that many deals are done direct and done as a basis transaction, right? But they are not traded on the exchange. So it's a huge means of conducting business. It doesn't mean that all of it takes place on the exchange, but it certainly is not as liquid as Henry Hub. Um, but it's more liquid than you would think, right? I mean, there is, depending on the different locations, there's a lot of activity, and especially within the month, there's a lot of activity.
Yeah, that makes sense.
Okay, so let's go to the next one that says basis relationships, Permian production.
Yep, there we go.
Okay. Gosh, I know it might be a little bit tiny. So I was taking a look just to give everybody, get your mind in the right place, when I'm talking about basis, because in a lot of ways it represents the cost of transport. I mean, also there's a supply demand factor in it. So if you look at, kind of in and around Texas and Louisiana, you have your, over in the left, that Waha location, that's really the Permian production, the producing area. And the way that the transport infrastructure kind of exists today is that it really moves. Of course, it moves to the West Coast, but I'm not including that in here. So we'll just follow this example. You can move it up to, to the Mid-Con market. You can move it to Texas, Oklahoma market. And each one of these boxes is a pricing hub that trades on ICE or over the counter. So these are all like the liquid pricing hubs. And of course, what you're trying to do is move it around and get it to the highest price market. So you can kind of see, I have the 1, 2, 3, 4, you move it kind of up, over, and then finally you get down to Henry Hub and then over to Houston Ship Channel, which would be industrial use, right? But also exports. And if you look at the curves up above, it makes sense, right? You see where it's produced, the light blue line, Waha, it's the cheapest, right? And then you have to move it to the next market, which is the pink line, Mid-Con, right? And you have to pay again to move it over. And the highest price in this example here is Houston Ship Channel. And of course, that's additive, right? So number one, you got to go on all of these different pipeline companies, and you have to get negotiate, you have to find room, you've got to move it all the way around. And the reason that Permian production, you hear them talk about it being sort of stranded, is that it only has a few outlets at the moment. It'd be nice if they could get that, pipeline just going directly through the center of Texas, right? And directly over to Henry Hub, which, as you know, it's not been nothing but pipeline expansions and projects. And so the expectation is that this supply will eventually have an easier, lower cost option to get to the hub pricing. When you have to sort of wheel it through a bunch of different transmission providers, you pay a lot more than if you can go direct. And so the other side of that, of course, is then there's more inexpensive supply coming into Henry Hub. But right now it's constrained by the fact that not enough capacity. So for a lot of times they flare as much as they can, right? This is all this associated gas that's sitting down there. I mean, honestly, I have no expectations of getting, $1.45 is probably enough, right? Because it's just their intent is to get the crude oil and all the liquids out of that gas.
What's the typical basis between, and I know it varies, that's what we're talking about, but
Yep.
how volatile is the basis typically?
In the winter, it's incredibly volatile. And the reason that it gets so volatile is that there's X amount of pipeline capacity from one point to another. And as demand exceeds pipeline capacity, it moves to scarcity pricing, which is why you'll see Henry Hub trading $3 and Algonquin, which is, Boston, trading $100.
100?
Yeah, I think we got up to 120 or something. The high was this last winter for gas out in the Northeast. So it really just becomes, it doesn't matter. There is not enough pipeline capacity to get it there. So you have to, allocate. The price signal goes towards switch to fuel oil.
Yeah, absolutely. At those prices.
And that's a whole other thing about the winter in the Northeast. Most of them, in order to secure the power generation in the Northeast, and to be considered like a firm resource, you need fixed firm pipeline capacity. And a lot of utilities can't get that. Number one, power generation is second in line to LDCs for dispatch in the winter. So if there are any constraints, the power is not getting it, the power generation, right? So they have to keep alternative fuels on site, and they have winter reliability programs for them to buy fuel oil, keep it on site, and if it's not used, they get reimbursed a certain level for any unused at the end of the season. So thank God, right? Because if you don't have firm transmission, you're not a firm resource for power dispatch.
Interesting.
Okay, so go on to the next one, and that's actually the Appalachian
Yep.
region, which is the Northeast, although this is only through this summer. I guess I'll go to
So it looks like maybe TETCO runs from the Gulf up to the Northeast, it looks like, maybe.
So you kind of have, so if you look at Lady Hub, which is the number one, it's the light purple up in that market. That's kind of, let's call that Marcellus.
Right.
And earlier this summer, and that correlates, you can see the low, that's the cheapest price on this graph, at least for the summer. There were some constraints in that system earlier this summer, and they couldn't get it affected a lot of their takeaway capacity. And so you saw prices went all the way down almost to 75 cents earlier in the summer. So, to go from 75 back up to 250, I'd call that volatile. And then it's similar to what we looked at in Texas. You kind of have your producing region, which is, starting up in the Marcellus, and then you can move it down through to Dominion. And now with a lot of pipeline reversals, it heads back towards Henry Hub and towards the Gulf Coast. Or you can move it over towards Chicago and ultimately towards the mid-continent. And again, you see from a additive cost, or what you would think would be the cheapest to the more expensive based on logic, right? You can see that it's very similar to Texas. However, it's not as prominent because takeaway capacity in the Northeast is a lot further along than it is in Texas. So while these markets used to be much more discounted last summer and especially 2 summers ago, enough takeaway capacity has been put in place that they tend to get closer to Henry Hub pricing. And there's more coming online, and the intent is to get the gas flowing really west and south. So that's kind of backing out some of, the gas that traditionally used to flow out to the Northeast. But it is the Northeast that ends up getting constrained in the winter. And I think if you go to the next slide, futures curve.
Yep.
So the basis futures that we talked about and looked at in the beginning, if you price them out relative, so if you take the basis plus Henry Hub, this is what the curves look like. And you, like, for example, Algonquin, again, that's the Algonquin City Gate, which is up and around Boston, always is, it continues to be constrained by capacity. And so right now, we're at $11 for January and February as an outright basis. And that's the market I was talking about.
Right.
Tends to hit 100. When you hear these big numbers, you're generally referring to these Northeast markets, because as long as the system has pipeline capacity, it's not as if we don't have supply. It's just that we don't have supply to get to a particular region that needs it at a point in time. And I mean, that certainly helps, hype up the whole complex for sure. But at the end of the day, over time, the market's kind of gotten smart enough, and it knows that you can't physically get it from Henry Hub to Algonquin in those moments. So unless you kind of have the spot price pressure, upwards, it has a hard time following as kind of optimistically as it did in the past. And, that's just over time, people learn. So this, if you kind of take a look at, we were talking about if you were to hedge out your basis, if you were a producer in the Northeast and you wanted to hedge, the whole year at Lady Hub, for example, right? I mean, on an average, you're below Henry Hub, but you get kind of to some of the more demand centers. So TETCO really feeds into PJM, which is the big power hub for the Northeast, Pennsylvania, New Jersey, Maryland, and Algonquin, of course, New York and beyond, really Boston and the whole Northeast. So mentioning let's say you were a consumer and you bought NYMEX and you didn't buy the basis, you would be short that basis. You might win, right? I mean, last winter, I think Algonquin basis averaged $7.50 for the entire period. But there were days when it was 80, 90, and certainly 14 and 15, because that's the competition with LNG. So, and then you just have Henry Hub, liquid, all the major pipelines feed into it. It's not really, it's becoming more and more of a demand hub, but it's not logistically constrained. And so to get that to move up, as a whole, we need to go back to sentiment like, Mark and the market as a whole might have to kind of all believe that this is an unacceptable level of inventory coming into a winter, given, supply growth, demand growth.
Sure. And at this,
right. And then finally, I'll just wrap it up on that note, just talking about supply and demand. If you can go down, I think it's 2 more slides. There's a
2018 year to
slide,
date,
and then
the one that says
2018 year to date.
Yep, we're there.
So okay. So if you want to get into the nitty gritty, which it's like at some level you can do that with all the inventory reports for crude. And whatnot. And at the end of the day, when the market, turns, it turns, and it's not about these specific numbers, but they're interesting to know. So compared to last year, you can see that production is up 8 BCF cumulatively, and the Canadian imports are up just a little bit. So we're up on production, which is, we hit record levels. Pardon me?
Well supplied, basically, it looks like.
Yeah, But on the flip side, we actually had some extreme weather scenarios this year. In April, it actually was cold, and we had some pretty good gas demand, and we actually withdrew instead of injected supply out of storage the first couple weeks of April. So year over year, the cumulative demand was up 10. And so if you want to talk about like the balance, and when people say looser or tighter, you'd say this is tighter.
Right. More demand than supply for this year so far.
Correct. And that would be why we haven't put as much, in the ground, although it's not as if we've put as much in the ground cumulative to date this year as we have other years. It's just that we started from a significantly lower balance. And the last time we did that was coming out of the 2014 polar vortex, and prices moved up significantly. I have $3-4 up to maybe $4, and we put almost definitely not quite twice as much in the ground, but a lot. We started from a much lower level, and we put a heroic amount in the ground that summer, and we're nothing compared to that this year. So, just a lot of, I think boredom breeds boredom, right? When there's been no impetus, when it doesn't, if you haven't been hurt in a long time there's been no incentive. How about that? There's been no incentive to go in. I mean, just like airlines. When's the last time you heard about airlines rushing to hedge their jet fuel? Just only recently, right? I mean, you get kind of
well, I was going to say, I think we spoke to Phil Flynn about that a few weeks ago, that I think American was canceling some flights due to the higher jet fuel costs, and we're starting to hear about that a little bit more.
Yeah, and it's been a while since that was the case. There's been no angst on the consumer side, let's put it that way. Like, nothing was getting away from you. I mean, geez, I remember when oil, back when oil we went up to 100, 150. Individual people, when I say like consumers, generally you think of airlines or whatnot, but I mean, people, just neighbors, were talking about how to, hedge their own gasoline purchases.
Right.
There were creative things coming out with how you could like lock in your, I think car dealerships had promotions where you could lock in your gas price for a year when you bought the car. I mean, it's just that's all gone away.
What about solar? How about solar and wind? Can that replace anything that natural gas, the demand for natural gas at all?
Well, the interesting thing about that is, as the grid stands right now, and I mean, obviously, of course, I'm going to be general here, but in general, you need a firm resource to back up every non-firm resource. And solar and wind are non-firm, meaning that if, let's say, a nuke unit goes down, you can't just say, okay, turn on the solar. I mean, the solar is either on or it's not. At night, you can't just, it's not a firm resource.
Right.
So the way that the electric grid regulation works is you have to have X amount of capacity. So on the one hand, and it's why there's so much discourse about, subsidies for nuke plants versus solar and wind that you hear out there, because these tried and true coal, nuke, and gas plants are essentially needing to be there. But in case, and when the wind isn't blowing or the sun isn't shining. So, I mean, they can be a part of it. And the way, the Clean Power Initiative works is that renewables like solar and wind take grid priority. So if they're generating, they get dispatched first. They're always first in line, which that's not the case for any other type of resource. So, it can, but I think that's why people are real excited about needing some sort of battery technology, um, much further advanced than we have now. It's the drain on, you can charge a battery with these, but the drain to support a whole system. So I mean, we're certain, there's hopes, but for it to actually play out, there's a lot, the grid would need to change a lot. It certainly is incrementally making an impact in certain markets. Texas this summer, I mean, they have, I want to say 10 or 14,000 megawatts of wind and solar, or wind especially. And the fear and why August electricity prices in ERCOT ran up to $200 and some dollars, 230, is that on a given day when there was peak demand and the wind wasn't blowing, the system could be 10,000 short. That's how tight it is down in Texas. But,
So is that the next big step for those, like for solar and wind, is to basically be able to efficiently store it better?
Correct. I mean, because right now it's just, you only have it when you have it.
Right.
And so, in California, they have all this solar that they've put out there. So during the day, which used to be the peak time, everybody now is generating from their solar panels. And then the minute the sun shuts down, the huge draw that shows up to the power grid, right, to start to pull off of the grid, and it's just kind of changed the dynamics. And the highest price of the day now is when the sun goes down.
Yeah, well, that makes sense. We're actually getting a question, or I'm actually not sure if it's a question or a comment. They like your point. Great point about intermittency issues. Lithium-ion battery is encountering a problem with cobalt and refinement issues to be used as a store of power. Apparently, refined cobalt has an arsenic issue. How will they react in landfills?
Well, I mean, and I think hopefully I'm answering this, but I mean, I certainly wonder, with all this battery discussion and all this storage, the landfill impact of that. I mean, I feel like I've seen documentaries where they're emerging countries, they just have these huge dumps of cell phone batteries and computer batteries that are just leaching out stuff all over the place. It seems like that should get a little bit more press from, but the clean power people don't seem to, they seem to think that's already solved. But I would agree with you. It's not just so easy as to say we need a battery and some solar. We might need both of those things, but we need, not in today's technology, right? That needs, to be honest with you, how about we store it in water? Store it in some sort of pump hydro. There are a lot of options. Batteries aren't the only ones. It's just what everybody thinks of. I'm not sure if I answered that, but I agree that there's a lot of, who wants a bunch of spent batteries piled up all around the country?
Right.
And let's see, that might be it. What was my last slide? Oh, which is the last slide, basically saying here are the curves. So Henry Hub is our main one in black. If you were to look at the three major shale regions, we have Rockies, which is Niobrara, and Waha, which is Permian, and TGP, which is up in the Marcellus. You can see that really, I think Waha, or the Permian area, is the one that's still lacking enough takeaway capacity. And another reason that people feel not so bullish in general on natural gas is this fear of when that hits the markets. But, I'm just putting it out there for what that is, that there is this, once that supply is no longer flared and it can just come pouring through. Now that would be, best case scenario, but it's not now. It's not, tomorrow.
Yeah. Well, let's stay let us know what you find when those major changes happen, and let us know.
So anyway, that's just a primer while we all, wait for us to get past
Like
these
you
next
said,
couple of big
September
things.
7th, the September 7th report, which comes out on the 13th, should be a key a volatile, potentially catalyst.
Yeah, at least a milestone. Like, okay, that's behind us. And now, okay, now we have 8 weeks left in the storage season. So, there's this mythical, we're maybe just going to put a ton in for the next 10 weeks. Every one we chip away at is more knowledge of the end state.
Okay, good. Well,
so, okay, good.
Let's
all right, well, thanks, everyone.
keep us posted, and we'll talk to you soon.
Okay.
All right. Thanks, Brynne.